Hey everyone! In today's fast-paced world, technology is the driving force behind the next big wave of growth. Every investor should have some tech in their portfolio, but let's face it, picking the right tech stocks can be challenging. With so many companies claiming to be the next big thing, the risk of making a wrong choice is high. This is where ETFs come in. They offer a diversified slice of the tech sector, spreading out the risk while capturing overall growth. Many people focus on low expense ratios when choosing ETFs, but the truth is, those fees are often so small that they barely impact your overall returns. What truly matters is the performance of the ETF itself. In today's video, we're going to discuss why expense ratios may not be as critical as you think and how focusing on overall returns can lead to better investment decisions. Sometimes, the easiest route is to buy an ETF that covers a wide range of tech stocks. But with so many choices, which one should you go for? Stay tuned, because I'll share my top 4 technology ETFs and reveal the best one for trading options. These picks will simplify your investing and provide powerful tools to harness the tech sector's explosive growth. Investing in ETFs is a smart, straightforward way to ride the tech wave without the hassle of picking individual stocks. Let's start by talking about the Invesco QQQ, with a 2% expense ratio and an impressive year-to-date return of 22.93%. The QQQ is a solid choice for anyone looking to get broad exposure to major tech and growth stocks. It tracks the NASDAQ 100 index, which means you're investing in some of the biggest names in tech like Apple, Microsoft, and Amazon. While the QQQ provides a diversified and strong tech portfolio, it might not be the best pick if you're looking for something with more specialized or higher growth potential. If you want broad tech exposure with solid returns and are okay with its focus on established giants, the QQQ is great, though not the ultimate option. Next up, let's cover one of my favorites, Vanguard's Information Technology ETF, also known as VGT. With a super low expense ratio of just 0.1% and an impressive year-to-date return of 27.46%, VGT is a fantastic choice for investors looking to maximize their tech investments without breaking the bank on fees. This ETF covers a wide array of tech companies, from giants like Apple and Microsoft to innovative players in the industry. Compared to the QQQ, which focuses on the NASDAQ 100, VGT is more concentrated specifically on the tech sector, offering a broader and deeper dive into technology stocks. If you're looking for a diversified tech portfolio with a focus on high growth and low cost, VGT could be the perfect fit for you. It's ideal for those who want strong exposure to the tech sector with top-tier returns and are looking for a more tech-centric approach than what the QQQ provides. In my portfolio, I invest $50 daily into both VGT and QQQ. This strategy, known as dollar cost averaging, is crucial. Different parts of my portfolio carry different risks, and I view VGT and QQQ as low-risk, long-term investments because I'm bullish on technology. Instead of betting on a single tech stock, I leverage the tech sector with these two ETFs. However, I also take bigger risks with top tech stocks like Nvidia. You need to find what works best for you. Our next ETF is Invesco's Semiconductor ETF, SOXX, with a 1% expense ratio and an impressive year-to-date return of 43.51%. SOXX is an excellent choice for those interested in the semiconductor industry. Unlike QQQ, which covers a broad range of tech giants, SOXX focuses specifically on semiconductor companies, offering exposure to key players like Nvidia and Intel. The major advantage of SOXX is its growth potential driven by the booming semiconductor sector. However, this focus also means higher volatility compared to a more diversified ETF like QQQ. If you're seeking high growth and can handle some market fluctuations, this ETF could be right for you. It's ideal for those wanting to capitalize on the semiconductor surge while understanding the associated risks. We have the Semiconductor ETF SMH, with a 0.35% expense ratio and a staggering year-to-date return of 62.3%. SMH is a powerhouse for those wanting to invest heavily in the semiconductor industry. Compared to SOXX, which also focuses on semiconductors but has a higher expense ratio, SMH offers slightly broader exposure within the sector, featuring big names like Taiwan Semiconductor and AMD. Let's address the expense ratio. VGT offers a low expense ratio of 0.1%, while SMH comes in at 0.35%, which is 3.5 times higher. Here's the deal, being overly frugal and fixating on tiny fees won't make you rich. Do you want to build wealth, or do you want to pinch pennies? Focus on what truly matters, performance and growth. Stop sweating the small stuff and start making smart investment decisions. Now, let's look at some hard numbers. If we had invested $10,000 in each of these 4 ETFs at the start of the year, here's what our returns would look like. SMH would have given you a $6,175 profit, while QQQ would have brought in $2,268. Let's focus on a crucial point: being cheap can cost you big time. For those obsessed with expense ratios, here's the breakdown. Annual fees for QQQ would be $24.59, and for SMH, $56.81. That's a $32.22 difference, but look at the profit difference, $3,907 more with SMH. Yes, QQQ is more stable, and SMH has higher risk and volatility, but the main takeaway here is to focus on returns, not just expense ratios. We're talking about a $32 difference in fees for managing your investment for an entire year. Don't be petty. This comparison shows that fixating solely on the expense ratio is a mistake. Higher performing ETFs with slightly higher fees like SMH can deliver significantly higher net profits compared to those with lower fees but lower returns. It's crucial to consider both performance and expense ratios when making investment decisions. Don't let a small difference in fees obscure the potential for larger returns. Make informed choices and focus on what truly matters. This isn't to say SMH is better than QQQ. Both ETFs serve different investment goals and cater to different risk appetites. Understand your own objectives and choose accordingly. Now, regarding stock options, which ETF is best for trading stock options? My top pick is SMH, and it's not even close. It offers weekly options, solid trading volume, and tight spreads. This setup allows me to profit from both the ETF and the options. Let's dive into one of my Patreon trade alerts and see how it all comes together. I recently made $4,060 on SMH, achieving a 98.7% annualized ROI for the 71 days I held the stock. Want returns like that? That's the power of options. So, which technology ETF is the best fit for you? Ultimately, you'll need to decide based on your investment goals and risk tolerance. If you're long-term bullish on technology and prefer to keep things relatively conservative, my top picks are QQQ or VGT. They offer solid returns with lower risk. But if you're willing to take on more risk and embrace higher volatility, SMH could be your ticket to significant gains. Personally, I invest in all three. Let me know in the comments which ETFs are your favorites and why. Remember, the right ETF can make a big difference in your portfolio. Don't just sit on the sidelines, take action and start riding the technology wave today. And one more thing, don't focus solely on the expense ratio. Look at the big picture. I showed you how on a $10,000 investment, the expense ratio cost difference was just $32, that's about half a tank of gas. Make smart choices and focus on the returns. Keep it real, and I'll see you in the next video.